Now we will see together a new indicator. His name is moving average, convergence and divergence. So firstly, we will see his definition, how it's composed. We will see how to set up this indicator. Then we will see the interpretation of the signals generated by the MACD and how to identify these signals. Finally, we will associate this indicator with a new one, which is the relative strength index indicator. Moving average, complement and confirmation of trend. We have noted earlier that moving average are ideal for identifying the cyclical character of a chair, new trend, and their reversal. However, in spite of the crossing angle that can help us validate our opinion on the situation of a chair, you have understood that the exclusive use of moving average is not sufficient. It would be interesting to use an indicator that would allow us to observe a change in trend beforehand. To do this, we will use the moving average, convergence and divergence, MACD. The MACD is a technical indicator used to confirm buy and sell signals. What determines the success of these indicators is the fact that signals emerge much earlier than those resulting from moving average alone. Unfortunately, there is no magic formula, and paradoxically, its strength is also its limit. Indeed, the earlier an indicator generates signals, the more important the risk factor is. Moving average, convergence and divergence. MACD means convergence and divergence of moving average. We therefore understand that this indicator is derived from a moving average as seen above. Indeed, the MACD is simply the difference between two moving averages of different periods, one called short, for short-term character, and the second one called long, for long-term character. In this case, we prefer use exponential moving average in order to attach particular weight to the most recent value. Let's see the notion of divergence. Divergence is the non-correlation between the evolution of a chair value and the evolution of the indicator. As a result, it suggests the probability of a reversal of trend. We distinguish a bullish divergence from a bearish divergence. When a stock is trending downward, while the indicator does not show any new lows, we will be faced with bullish divergence. This suggests a trend reversal or a future rebound in price. Inversely, when a value is trending upward, while the indicator is not moving higher, a bearish divergence will occur. This suggests a trend reversal, a correction, or a period of selling a price. The first striking difference of this indicator is that it is composed of three elements: the blue curve, which represents the MACD value line, the orange curve, which represents the MACD signal line, and an histogram. First, let's understand how these different elements are shaped. The MACD value line corresponds to the difference between the exponential moving average set up in a medium term, thus 12 period, and the exponential moving average set up in the long term, thus 26 period. Then, the MACD signal lines simply represent a short-term exponential moving average of 9 periods. The histogram is generated from the difference between the MACD value and the MACD signal lines. So, MACD value lines minus MACD signal lines. When a value is in a downward trend while the indicator does not draw any new bottoms, we will be faced with a bullish divergence. This indicates the possibility of a trend reversal, thus a future rebound of price. Moving average, convergence and divergence setting. As explained before, the MACD results from the difference between two exponential moving averages of different periods. In practice, a period of 12 sessions is used for the short-term exponential moving average and 26 sessions for the long-term exponential moving average. You can see the different formulas. So as the formula shows us, we have three elements that compose this indicator. The MACD value, so that is simply the result of short exponential moving average minus long exponential moving average. We have the MACD signal line and the histogram. Signal interpretation and identification. For bullish anticipation, our first signal of upward anticipation is located when we observe a crossing between the MACD value and the MACD signal line. The angle at which the two curves intersect is once again important. The more significant the angle is, the stronger the trend signal will be. Furthermore, a reduction in the histogram value volume gives us a signal of a probable trend reversal. Moreover, for bearish anticipation, a bearish expectation signals occur when we observe a cross between the MACD value line and the MACD signal line, moving downward for this time. Indeed, the crossing angle and the reduction in the histogram volume give us also a signal of a probable trend reversal, as well as the strength of the supposition. Let's check in practice this new information. On April 12th, we observed that despite an upward trend in the value line and the signal lines, the histogram shows a downward trend. Thus, the histogram is detecting a slowing down of this dynamic and a possible reversal of trend. This negative signal is confirmed at the market close with the downward cross between the MACD value line and the MACD signal lines, as well as the fall of the Chesapeake price. Then, on April 16, we notice a bullish divergence between the price and the MACD curves. This divergence indicates the possibility of a future rebound in the price. In addition, simultaneously, all the elements making up the MACD indicators become optimistic. The MACD indicators therefore shows an increasing histogram as well as an upward crossing of the value line with the signal lines. At this point, everything was in place to confirm the hypothesis of an optimistic future market. This hypothesis was subsequently confirmed a few days later. During this rebound, even before its major correction on April 27, the MACD indicator warned us of a negative signal on April 26, with a move towards the signal lines and a noticeable drop in the histogram. On April 29, we reached an area of uncertainty with the junction of the two MACD curves and the fervently upward trend of the histogram. At this point, it could expect two situations: either a strong rebound in the price or a reversal of trend. In consideration with the latest price development, we could have given a higher probability of the second hypothesis. Once again, this is just the right spot. When the market opened on 30 April, the price suddenly plunged into a selling period. Finally, an interesting situation occurred on May 2. We had once again a multiplication of positive signals, also from a bullish divergence. However, we can see here that this indicator is not infallible. It's essential to use several indicators in order to reduce the risk factor.